All right, Christina, Mary, welcome to those who might join us a little bit later or review this at a later time. We did have to switch the time this week and the day, not the time, but the day this week due to the holiday. I hope you all had a wonderful 4th yesterday and a good holiday weekend. It always is kind of hard to get work completed on holiday weekends and get it all in. It's also hard to get back into the pattern of things once we've had a holiday. So I understand that. I noted that a lot of you are missing responses or, just different parts of your assignment or discussion board comments from last week. And as we discussed last week, I encourage everyone to always, even if you find yourself behind, still complete the, different work that even if you're late on it, because I'll still give you partial credit. One of the other things that this week with the holiday created was I'm about a day behind on grading. Usually, as I mentioned last week, I'll have a grading done by noon on Tuesday, even though the school's policy is noon on Wednesday to get all the grading done by then. This week it'll be by noon tomorrow because of the holiday yesterday. But going forward, as we talked about before, usually it'll just be by Tuesday, and you can count on getting all your work done, or excuse me, feedback on all your work as far as grading is concerned. So last week I've gotten all the discussion boards done. You should already have feedback, of course, on your assessment and your checkpoints, but I've gotten all the discussion boards that were turned in on time completed and graded, and I'll go ahead and get assignments done tonight or tomorrow morning, so you have feedback there. If you, as I mentioned earlier, if you find yourself behind at this point, that's okay. Get caught up as fast as you can or as soon as you can, and try to stay caught up for this week with the work that we have to do. So tonight, as far as the agenda, we want to make sure and cover the material from chapters 11 and 12. 11 is about bonds and 12 is about mutual funds and ETFs. And so it should be interesting, should be some good takeaways, just information that's good to know going forward with 401ks and IRAs and things like that that you all will at some point have through your workplace or hopefully establish on your own if you need to, if you're self-employed. So anyway, we'll talk about those, and we also need to spend a few minutes, as we always do, on the test this week. The test this week has 20 problems instead of 10. It's worth 100 points instead of 50. So it's worth more. There are more problems, but it still shouldn't take any longer than about an hour. They're all multiple choice or true false questions. And as I mentioned, there are only 20 of them, so it shouldn't be too bad. The material, though, as I mentioned, is from chapters 11 and 12. And we'll be going over a lot of the material tonight because we have a little bit more time to do that. Last week we covered expectations, grading, what to expect from the course. This week we don't have to spend as much time doing that, and so should have more time to cover the content. But we do need a little bit more time tonight to cover material on the test because it's a little bit longer. So before we get going tonight, any questions about the discussion board from last week? Just a reminder, if you got like one post completed or 2 posts completed out of the 3 that are required, you are able to go back in and complete more posts. No guarantees on how soon I'll grade it, but all of it will be graded before the end of the course. And I will give you additional credit, just not full credit, for work that's turned in or completed late. It's one of the easiest ways, though, to get additional points. So I suggest or strongly encourage you to consider getting those extra posts completed to have all 3. But any questions about last week's discussion board before we talk about the assignment this week a little bit? Okay, this week's assignment is pretty straightforward. It's a chapter end question again. Once again, the question feels like kind of a short answer situation, but the instructions call for 3 to 5 pages. Note that this week, specifically for this week, I'm not going to be as strict about getting to 3 pages. I won't dock your score if you don't get to 3 pages, but try to add as much content as possible and be very complete about how you answer the scenario this week. So even though, like I say, I'm not going to hold you to 3 pages, I still want complete paragraph form answers. I don't want just one word or partial sentence answers to the questions in the scenario. Okay, so that's that. A lot of you have assignments from last week that you need to still get in, so make sure and look to the ebook, study the material from that chapter. It'll make the assignment I'm not going to say it's going to be easy, but it's going to be a lot easier, relatively easier, excuse me, if you've recently reviewed the material from the chapter before completing those end of chapter questions. Okay. All right. Mary, Christina, Amanda, any questions to this point before we get started on chapter 11? Okay. So we're going to talk a little bit about bonds tonight, and then we're going to talk about mutual funds and ETFs. As I mentioned, ETFs are exchange traded funds, but they're always referred to as ETFs. So ETFs and mutual funds are very similar, and we'll talk about them here in a minute. But one of the things we need to talk about or spend just a second on before we get into either one of the chapters is kind of a foundational point that many of you might already be well aware of, and that is the difference between stocks and bonds, and how stocks and bonds are the fundamental instruments to all market investing. And I say market investing because there are other things you could invest in, like real estate, gold, silver, oil, gas, precious metals, other things that you can do. But when it comes to market investing, we're talking about the stock market, but also just markets in general. The cornerstones of market or investing are bonds and stocks. Bonds are debt of companies, and stocks are equity ownership in companies. So this might be a review for all of you, but just as a quick heads up, when we talk about a bond, we're talking about a company's debt that we've invested in. And so they're going to pay us back interest over time, as well as they're going to pay us back our principal or the money that we invested at the end. So just as an example, I think I mentioned this last week, if Walmart wants to build a bunch of new locations in China and they don't want to use all their cash and operating cash position, because that would be foolish, they may decide to bond for the money, which means that they go to an investment bank and have them underwrite a product called a bond, where you and I as investors and other institutions can buy those bonds. And that is the way that Walmart can raise some money in order to go and build new locations. Now, in return for us investing our money in those bonds, Walmart is giving us a promise that they will pay us interest over time, so maybe 5% over time, plus they promise to pay us back the total balance that we invested at the end of the term, and maybe that's 10 or 20 or 30 years out. Okay, so that's a bond. It's similar to something like a car loan or a mortgage between you and the bank, just the reverse of it, right? Instead of the bank investing in you and I and us paying interest back to the bank, when we invest in bonds, it's like the opposite of that. It's like we're acting like the bank, where someone else is paying us back interest over time and paying us back on the loan. Okay? All right, so that's bonds. As far as stocks are concerned, a lot of times we refer to stocks as equities, okay, equity positions. And it's because equity and ownership are interchangeable. And when we own a stock in a company, we own partial interest or partial ownership of that company. If I own a share of Apple stock, that means I own a very, albeit very small, but I own a partial interest in the company. And if the company has success and pays out dividends, I'm going to participate as an owner in Apple when they do that. Okay, so when they pay out a dividend distribution to all their owners, I get part of that based on how many shares I own. Okay, and if the company goes bankrupt, I also participate in that result, which means that I end up with nothing. So about 7 years ago, the federal government came in and bailed out GM and Chrysler, right? Well, if you were an investor in GM at that time, in GM stock, your stock position in GM would have gone to zero. And then after GM was reorganized and the federal government bailed them out, you could then reinvest in GM if you wanted to, if you didn't feel so burned by it. You could reinvest in GM stock after the reorganization. But everybody who owned the stock prior to that bailout got nothing and had zero. So let's say you invested $100,000 in GM stock in 2005. 4 years later, that $100,000 would be worth nothing. Okay, so that's a risk of stock investing, is if a company goes bankrupt or gets reorganized like GM did, you might end up with nothing. The other side, if you were a bond investor in GM, and this is an interesting thing to note, if you were a bond investor in GM, you are still getting paid your interest and you still have the promise from GM to get your principal balance back. So you didn't go to zero if you were a bondholder, but you did go to zero if you were a stockholder in GM, the auto company. All right, so those are some examples. those are some definitions of stocks and bonds. And as I mentioned, stocks and bonds are kind of the fundamental cornerstone or fundamental foundation of what most all other investing is part of. So when we talk about options, when we talk about mutual funds and ETFs, when we talk about derivatives, all these different things come from, in large part, stocks and bonds. Okay, those are the building blocks for all those different other products when it comes to investing. All right, any questions about what stocks and bonds are before we get a little bit go into a little bit more detail as far as bond valuation? Okay, so let's learn a few things about bonds and how they are priced. So how do you measure the return that we should expect from a bond? Well, you take the real rate of return, which is the real rate of return is the rate of return after inflation is taken out. You add in inflation and you add in a risk premium, okay, for the risk of that bond going away or defaulting. And all those combined should equal your required rate of return for the investment. Okay, so if I'm going to invest in bonds, I want a real rate of return plus I need to account for inflation plus I need to account for risk, right? And if I can account for all those three things and get some kind of return total that's worthwhile, right, for you and I to invest, then we'll choose to invest in it. If it's not enough, if the yield on a bond, if the amount that a bond is going to pay us doesn't exceed our required rate of return, meaning the return that we expect plus inflation plus the risk, then we don't invest in it. Okay. And if enough people around the world and institutions around the world are gauging the value of a bond all at once, it actually very quickly makes the price of a bond exactly what it should be. What does that mean? It just means that pricing on bonds ends up being kind of scientific. And I mentioned this in my post this week on our discussion board, and that is when it comes to stocks, people's emotion plays into stock pricing significantly. So a lot of people like Apple stock or Tesla stock, and so those stocks are sky high, while a company like Monsanto, who a lot of people hate because it's a company that focuses on genetically modified products and chemicals, a lot of people hate that company, so that company stock is not nearly as popular. And even though Monsanto might be a much more financially sound company than, say, Disney, which, I'm just giving a random example, Monsanto's stock price might be much lower because less people like Monsanto and a lot more people like Disney. So that's stock pricing. When it comes to bond pricing, we don't care whether or not you like the company or not when it comes to pricing bonds. All we care about is what we have to have from as far as return, as far as interest return, plus we've got to account for inflation, plus we've got to account for risk, and whatever our estimate on that is, that's what we're willing to pay for those bonds. All right, so the bond market has lots of different parts. When we talk about the bond market, it includes business bonds, corporate bonds, what we call corporate bonds, which are just business bonds like the ones that I described when I gave the example of Walmart. That would be considered a corporate bond. Then there are municipal bonds, which are state and local government bonds. For example, the city of Provo, Utah, which is where I live, issued a bond a few years back to develop FiberNet. So fiber for internet use in the city of Provo, and they bonded for it because it costs a lot of money to put fiber into the ground for everybody, all their citizens, and they bonded and created municipal bonds that anybody could invest in, and then Provo's been paying that bond back over the past 10 plus years. Okay, so cities and counties bond all the time. You may have already voted for a primary election here recently. Probably didn't have a bonding issue on that vote, but here in the fall when we vote for the president and have the election, it's pretty likely almost every fall election seems to have some bonding issue. So they'll bond for schools, they'll bond for museums, they'll bond for parks, they'll bond for all kinds of different things, and that's local government raising money from you and I in order to build those different infrastructure items. Okay, so recently in Provo we bonded to build a new high school, Provo High School, and so the taxpayers in the city of Provo voted on whether or not to allow the city to take on additional debt. Okay, it's not you and I giving them that debt, but it's allowing them to go out and get debt from investors. And of course, that means that our city has more debt. So that's the reason we have to vote on whether or not we'll give them permission to do that or not. Some bonds pass, some bonds fail. Most community bonds, by the time they get on the election ballot, they're going to probably pass. Okay, meaning we're going to probably allow them to bond for whatever it is that they're trying to get permission to do. Okay, so that's municipal bonds. And then you have what's called U.S. Treasury issues like T-bills, T-bonds, and T-notes. So those are Treasury notes, Treasury bonds, and Treasury bills. And the only difference between those three is just the length of time before they mature. So Treasury bonds are long-term maturities, usually 10 or 30 years. Treasury notes and Treasury bills are short-term. They can be a few days or they can be a year, but usually they're a year or less between Treasury bills and Treasury notes. Okay. And as a general rule, the shorter the maturity, the shorter the length of time we have to wait, the lower the interest rate that we get. So if you know anything about CDs at a bank, you'll know that the longer you lock in a CD, the more the bank is going to pay you, right? The same is true for Treasury bonds, for municipal bonds, and corporate bonds. The longer the bond term, usually the higher the interest that they'll pay us. The shorter the term, usually the less money that they'll pay us. Okay? Those are the three main types of bonds. And among those three, when we talk about the federal government having 16 trillion, what will be close to $18 trillion in debt over the next few years, that number comes from the fact that we've borrowed that amount of money from other people, countries, and investors and institutions around the world. And we have to pay them back those debts along with interest over time. Okay, so that's why people are concerned about the national debt, because that's an obligation of the United States to pay back other people with interest the debt that we owe. And so at some point, if interest rates go up, obviously that would be a considerable burden on you and I as taxpayers here in the United States. So sometimes people hear this national debt, of $16 trillion or $18 trillion, and the number's completely insane, right? That just sounds like funny money or monopoly money. It's more than monopoly money, right? To most of us. It doesn't even make much sense. But if you just will remember your lesson on bonds, you know that the federal government owes all that money to other countries, to institutions, and individuals. And over the upcoming years, they have to pay those bonds back with interest. Okay, so that's why we're all concerned about the national debt. It's because if it spins too far out of control, it's like you and I as individuals spending too much on credit cards. At some point, the party ends, right? And sometimes it ends very poorly for us if we're not prepared for that. Okay? All right. Usually municipal bonds pay less, 20 to 30% less than corporate bonds, and the reason for that is municipal bonds pay tax-free interest. So if I want to invest in bonds, I'll invest in municipal bonds that give me tax-free income, unless there's a comparable corporate bond that pays me a lot more, 20 or 30% more, to make up for the tax difference. So what is the big advantage of municipal bonds? The big advantage of municipal bonds is that they pay income tax-free. When I get interest from my municipal bonds, I don't have to pay federal income taxes on them. So very wealthy people love municipal bonds because they get tax-free income. They don't have to pay taxes on the income they get from them. And states and communities love municipal bonds because the reason that they get to pay less interest is because the consumer, whoever's buying those bonds, doesn't have to pay interest on, or doesn't have to pay taxes on them. So does that make sense? So the reason that Provo, when they bonded, pays less interest is because if I buy a Provo bond, I don't have to pay taxes on it. So I can take less interest and still end up the same as if I bought a corporate bond that was more expensive, or paid more interest, because I have to pay taxes on corporate bond interest. Okay, so if I get 5% from a municipal bond and I get 5% from a corporate bond, the 5% from the municipal bond is way better, right? Because I don't have to pay taxes on that, where I do have to pay taxes on the 5% corporate bond. Just something to keep in mind, because as you make decisions about what to invest in the future, you may get to a point where you have very high income and you want to invest somewhere to not have to pay taxes, and municipal bonds are a great shelter from taxation. And they also support local infrastructure. And a lot of people invest in municipal bonds because they want to feel like they're supporting local schools, local parks, things like that they care about and want to participate in. Okay? So now you know what bonding is. Now you know why on the election ballots a lot of times you'll see a bond, because that's your community or that's your county asking for permission to be able to borrow money in order to build some kind of infrastructure, like a school, for example. And all bonds have what's called a credit rating. And the way you want to think about this is similar to you and I's credit score. Very complicated, right? Credit scores are kind of a complicated issue. The higher your score, the better. The lower your score means that you're not as credit worthy. You may be the nicest person in the world, but as far as banks are concerned, if you have a low credit score, that means that you are not as trustworthy when it comes to paying back your debts. Okay, what, right or wrong, that's just what that means. And the same thing is true for bonds. Corporate bonds and government bonds, both local as municipal bonds and federal bonds, all get rated. And depending on how high the rating is, that's how much interest they have to pay out. So if they have a really good high interest rate, or excuse me, a really good high rating, like a AAA rating, then they get to pay the lowest interest rates. If they have a really low credit rating, then they have to pay very high interest rates. So there's an inverse relationship between the credit rating of a bond or company and its interest rate. If you have a really good credit rating, you don't have to pay as much interest. If you have a bad credit rating, you have to pay much more interest. And the same is true for you and I with our credit scores, right? If we have a really good credit score, we pay lower interest. If we have a bad credit score, we pay higher interest. The same is true for bonds. Okay? All right. I need to skip a few things. One of the most important things that you need to come away with tonight regarding bonds is this relationship that this graphic on the screen shows us. Can everybody see the finger pointing graphic that we're looking at here? Just want to make sure that the slides are actually moving. Sometimes they get caught. Thanks, Mary. Thanks, Amanda, for checking. So the whole purpose of this slide is to tell you, okay, and to help you understand that if interest rates are going up, then bonds and bond investments will go down in value. And if interest rates are going down, then bonds and bond prices will go up in value. So based on this graphic, okay, based on this graphic, if I were to tell you that over the past 30 years, interest rates have been on a downward trajectory, meaning for the most part, they've been in a downward pattern the past 30 years, ever since the 80s. What would that mean about bonds over the past 30 years, based on the graphic we're looking at? Yes, thank you, yay! People are actually paying attention. Christina, Amanda, great job. Okay, so what this means is, over the past 30 years, bond prices and bond investing has been very, very good, okay? In fact, there are many 10-year periods where bonds outperform stocks, which is not normal, okay? Usually bonds are very slow and conservative, but there were different times over the past 30 years where bonds did really, really well. And in large part, that was due to the fact that interest rates, in large part, have been coming down. Now, if I were to tell you all that I fully expect interest rates to go up the next 10 years, let's say, what would I expect bond investments to do over the next 10 years? Yep. So this is something very important to come away with from a class like this. This is like a life skill, knowledge skill thing that if you just have it in mind can really save you a lot of heartache. And that is that if let's say for example, my parents are about to retire, and they come to me and they say, hey, you're in school, you took a class on investing. What do you know about bonds? The most important thing that we can tell them is that if interest rates are to go up, bond prices will come down, and if interest rates go down or stay down, then bond prices will do fairly well. Why is that important? Because when people near retirement, most of the advice that they get is for them to invest more in bonds, right? I don't know if you've heard that before, but as people near retirement, they're told that they should invest a lot more in bonds. And so we have a lot of baby boomers right now, our parents and grandparents, who are retiring, and they're putting all their money in bonds because bonds historically are safer and more conservative than stocks. And while this might be a decent approach, they just need to be very aware and understand the risk associated with putting all their money in bonds, which is if interest rates go up over the next 5 or 10 years, their investments will go down in value. Okay, so they need to be visiting with an advisor or researching for themselves the different bonds that they have and make sure, because there's all kinds of different bonds, make sure that they have good bonds that won't go down as much as interest rates go up, and to not rely too much on the past 30 years of performance, because the past 30 years, as we've described before, is kind of an anomaly because almost all 30 years interest rates were going down. That's not going to happen the next 30 years. It can't, right? Interest rates can't go a lot lower than where they already are. And because of that, we're not in a situation where we can watch interest rates go from 18% like they were in the 80s down to 0, which is what they're at now as far as short-term treasury rates. Okay? That can't happen again because it's already happened, right? We can't go from 0 now to negative 18. The only direction logically that we can go over the upcoming 10 to 20 years is back up, right? And so that will hurt our bond prices, and we need to be careful about how we invest in bonds going forward. It's kind of a minefield, if you will, use the war term. Bonds are a challenging environment because the bonds that have done really well the past 30 years are probably not going to do so well the next 10 or 30. So we just need to be careful about how we invest in bonds. Doesn't mean that we shouldn't invest in bonds, just means that we need to be much more careful about how we do it. Okay. As an advisor, as an investment guy, the people that I work with, we talk about different types of bonds that don't react as much as interest rates go up. So some react a lot more than others. And so we should, obviously use the types of bonds that won't react as much right now to keep ourselves more safe. Okay. So if you get nothing else from tonight, just remember that adage: interest rates up, bonds down; interest rates down, bonds up. And if you have bond mutual funds or mutual funds that are focused on fixed income, what we call fixed income, which is bonds, then we need to be careful about this relationship with interest rates. And if we think interest rates are going to go up over the next 10, 15, 30 years, then we need to be a lot more careful about how we invest in bonds. All right, another little graphic. When inflation goes up, usually interest rates go up, and when inflation goes down, usually interest rates go down. I say usually because there are exceptions to this, but the Federal Reserve usually raises interest rates, when inflation is a problem, and they usually lower interest rates when inflation is not a problem. Okay, so if inflation is really getting crazy, interest rates are probably going to go up like they did in the 80s, and bonds will probably suffer. And then after interest rates are really high, that might be a really good opportunity to buy bonds going forward because they can do nothing but go down, right? And if interest rates go down, then you'll make money off your bonds. All right, here's interest rates and inflation. This is just a graphic that basically shows you that interest rates and inflation are correlated. You can see by and large they with a few exceptions, they usually are following the same basic trajectory, okay, as far as interest rates and inflation. I think I'm going to skip this slide. Got some different theories, liquidity preference. We've already kind of talked about some of this stuff. That's why I'm skipping some of it. But like the liquidity preference theory just states that basically you should get paid more for the longer term bonds, right? The longer your bond is, you should get paid more as an investor. Shorter the term, you should get paid less, and it's because of this liquidity preference. We put a preference or a value on shorter term instruments, obviously, because then we can get to our money, right? If we can get to our money faster, then that investment is deemed to require less interest. That's the liquidity preference. So sometimes you'll have yield curves, and when we talk about a yield curve, we mean short-term to long-term. Yield curves normally go up, right? So so short-term to long-term, the short-term has a lower interest rate associated with it. and the long term has a higher interest rate associated with it. If that's the case, then we've got a normal upward sloping yield curve, okay? And we have a downward sloping yield curve when we expect interest rates to fall. Now, if interest rates are at 0% right now, basically, as far as short-term treasuries are concerned, do we think that we would have an upward sloping yield curve or a downward sloping yield curve? Does anybody want to take a guess? Welcome, Ron. Based on the fact that interest rates are at all-time lows, do you think, based on this screen that we're looking at right now, that we have an upward sloping yield curve or a downward sloping yield curve? So just look at the first bullet point on each one. So an upward sloping yield curve results from the fact that we expect interest rates to rise, okay? And a downward sloping yield curve results from an expectation that we think that interest rates will go down further, okay? So does anybody want to change their? Yeah, so we're already at 0, right? So the expectation going forward is probably that interest rates are going to rise, and what that means is that we probably right now have an upward sloping yield curve, meaning short-term interest is less than long-term interest. And actually that plays out very accurately right now. A 10-year treasury bond pays you about 1.38%, meaning you'd only get 1.38% a year to hold a government bond for 10 years, which is really, really low in the grand scheme of things, or at least by history standards. And a 30-year bond is going to pay you more than 3%, which is still pretty low, but you're getting twice as much interest if you're going to hold a 30-year bond versus a 10-year bond, okay? And if we thought interest rates were going to go down further, then it would be the other way around. We get paid more on the short-term bonds and less on the long-term bonds, and that would be a downward sloping yield curve. Okay, kind of a hard concept because yield curves is probably a new concept completely to most of you. That's not a normal conversation term that we use at lunchtime with our buddies. Is there always risk that interest rates could change? The answer is yes, but usually we understand the direction, right? So Christina, even though there's always risk that interest rates are going to go up or down at any given point, most of us can fairly accurately project the direction. Meaning, right now, we can fairly accurately project, and I say fairly accurately because there's always a risk of it going the other way, but right now there's a consensus that interest rates have to start to go up, right? So even though there's a risk of interest rates changing up or down, usually you can make a pretty educated guess on which direction they'll probably go over the upcoming years. Okay? Did that answer your question, by the way? I don't know if... So yes, there's always risk about interest rates changing, but we can fairly accurately predict which direction they'll go over the long term. Now, over the short term, and this is a good example in the past 3 months, actually the 10-year treasury rate has actually gone down even further the past couple months. When Great Britain voted to leave the European Union, the 10-year treasury went from about 1.7 down to 1.4, which is where it's at now. So it went down, the yield on the 10-year treasury went down. Well, what this means is that bond investors actually did really well the last couple months because interest rates came down the past few months. Does that mean that interest rates will continue to go down over the next few years? Probably not, right? It's just a short-term issue related to Brexit, related to Great Britain leaving the European Union, the extra volatility in the world and risk in the world that created a downward push on interest rates here in the United States. And that was a surprise, Christina. So yes, there's the element of surprise, and that was a surprise. Most bond investors at this point are highly cautious, not expecting very many gains as far as upward movement in the value, but they got significant gains over the past few months post-Brexit. All right, so here is a basic investing strategy that we're looking at. And this goes along with what I was mentioning earlier on how I advise my customers and clients to invest in bonds. We're just careful, right? We still invest in bonds, but knowing that interest rates are probably going to go up over the upcoming 5 to 10 years, we have to be more careful about what bonds we invest in. Well, the bonds that we invest in the short term are short-term bonds. And the reason for that is because short-term bonds don't get beat up as much as long-term bonds if rates increase. Okay, they don't pay us as much interest, but they also don't go down in value as much if rates increase. So if you're concerned that rates are going to increase, one of the ways that you can hedge against that or protect against that is to invest in short-term bonds. Okay. If you think interest rates are going to go down, then a good thing to do is to invest in long-term bonds that you can accomplish significant upside from if interest rates were to go down. All right, I think that is all I'm going to cover on bonds because we want to get to mutual funds and ETFs for a few minutes before we cover what's on the test. But before I move on from bonds, any questions or concerns about bonds and how we value them? Okay, well, I pull up the next slides. And while I pull that up, the thing that we're going to be looking at, sorry, one sec. The thing that we're going to be looking at with mutual funds and ETFs is what is their purpose? Okay, what is their purpose? Why invest in mutual funds or ETFs? Mutual funds and ETFs more so than mutual funds now, but mutual funds have had almost 100 years of history of people investing a lot of money into them. The primary instrument or investment product that you use within an IRA, within a brokerage account with an investment person, within a 401k is a mutual fund. Okay, and so what is a mutual fund? We need to go over what they are, and we need to go over briefly what ETFs are too, because ETFs are a newer product over the past 10 years that are much more popular over the past few years than mutual funds. So mutual funds have kind of had the corner on the market of investing over the past 100 years almost. And now, just over the past 10 years, ETFs are gaining a lot more momentum. And as far as new dollars going into investments, a lot more new dollars are going into ETFs than are going into mutual funds. Okay, we'll talk about why that is and what the difference between these products are. But the general gist of why these products exist is their advantages. So the first mutual fund started in 1924, 68 mutual funds in 1940, but there are almost 10,000 mutual funds, different mutual funds today. So almost every single U.S. household owns a mutual fund. Most of those are in retirement plans because if you have a 401k at work, you have a mutual fund. And their mutual funds are a way for people to invest in investments, right, in the market, without taking all the risk of one particular company. We talked about GM, General Motors, a little bit earlier tonight. General Motors went bankrupt, right? Had to get bailed out by the federal government about 6 years ago. When that happened, stock investors in GM went to zero, as we talked about. So a way to protect against that risk is instead of putting all your money in a company like GM, you put your money in a mutual fund managed by professional money managers, okay, a team of professional money managers, and they manage that money for you, okay? For a fee, of course, for a cost, but it's a very minimal, nominal cost. And because it's so minimal and nominal, mutual funds become a very cost-efficient way to diversify your money and have professional management, okay? Did you catch all that? So the advantages of a mutual fund, and the reason mutual funds are so popular and common among investing today for retirement and investing in the market is because you have professional management, right? Most people aren't professional managers of money, of investments. Most people don't even care to know, about that. So mutual fund managers allow them to basically outsource, that professional management. Secondly, very low cost. It's a lot less expensive to buy $100 in a mutual fund than it is to try to buy a stock, okay, or a lot of different stocks. Thirdly, I get to diversify, right? I buy one mutual fund, it probably has 100 to 500 different stocks inside of it, so it's highly diversified. If I buy one stock, I might go to zero. If I buy a mutual fund, historically, no mutual fund has ever gone to zero. Okay, because it's so spread out, it's so diversified and professionally managed that you don't have that kind of risk associated with a highly diversified product like a mutual fund. Okay, so that's why people invest in mutual funds, and those are valid reasons why mutual funds are common and popular. Okay, here's that listing of different things that we just barely talked about. Okay. We'll want to know the difference between open-end companies and closed-end companies for the purposes of the test, and so just make sure you know that. But for the sake of time, I do want to cover ETFs for just a minute, because ETFs, or exchange-traded funds, are now more popular from a standpoint of new money going in than mutual funds. Okay, and ETFs are basically a copy of what mutual funds are. They're a copy of the good things, right? Low cost, diversification, professional management. Those things are all similar between ETFs and mutual funds. The thing that ETFs do that mutual funds don't is ETFs trade like a stock. Okay, you can trade an ETF, you can buy it and sell it any given day that the market's open. You can't do that with mutual funds. With mutual funds, you can only buy at the end of the day, or you can only sell at the end of the day. You can't sell throughout the day or buy throughout the day. And because of that convenience of being able to buy and sell throughout, ETFs have become a lot more common. There are a few other things that ETFs are doing a lot more commonly. They have a lot more indexing. Indexing is just a very low cost, no management, but just a pool, computer-generated pool of different investments. So it's a very, very low cost, and allows people to invest at a very low cost and still get what the market does, or what that particular index does. Okay, so that's another reason why ETFs have become very popular. And at the bottom of this page, this slide that we're looking at gives you some of the most common ETFs that are out there, like Diamonds. DIA tracks the Dow Jones. Okay, when we talk about the Dow Jones going up or down any given day, that's a group of 30 very, very large companies, and it's an index. Well, if you buy the DIA, you basically just track whatever the Dow Jones does. Spiders like SPY track the S&P 500, and QQQ is the NASDAQ. Okay, so these are different ways that you can invest in those different indexes, and basically those are market indexes that do what the market does. Okay. All right, so that's ETFs and mutual funds, just a brief summary or synopsis on what those are. Let's talk for a minute about what will be on the test. Okay, and then if you have any additional questions we'll probably have a few minutes at the very end where we can either go back to some more slides on ETFs and mutual funds, or if you'd like, we can spend more time kind of question and answer, Q&A on different things, topics that will actually be on the test. Okay. So this week, as I mentioned at the beginning of class, the test is a longer test. It's kind of like a midterm type test, and it's got 20 problems. They're all multiple choice or true or false, so it shouldn't take too long. But it's worth 100 points instead of 50 points. So if you struggled with the week 1 test, try to learn from how you struggled. So most people struggle because they don't study the book material very well. They think that if they listen to the session and just go in and do some Google searches, that they should be fine. These tests are meant to trick you if that's the way you're doing it. Okay? If you try your best to read and understand the chapter and actually go over the topics that I tell you are going to be on the test from the book, not just Google searching it on Investopedia, then your likelihood to get these problems right is much, much higher. Okay? So just a tip for these tests going forward. And some of you may have learned that the hard way in the week 1 test. You know, if it didn't go very well, consider switching things up a little bit on how you prepare. Okay? All right, so number 1 on the test. Number 1 on the test talks about efficient markets. This is a question from one of the chapters we covered in week 1. So this is a comprehensive midterm, so you'll have some questions from last week's material and some questions from this week's material. But week 1, problem number 1 is a question from last week, and the content from last week about efficient markets, and it basically asks you, okay, basically says, in an efficient market, how do you get the highest possible return? Okay, if markets are efficient, how do you get the highest possible return? So that question is answered in the text from last week, and pretty straightforward, but make sure you understand that concept. How do you get the highest possible returns from investing in efficient markets? Number 2 is another efficient market problem. It basically asks you to understand what the efficient market hypothesis is. And if you understand just basically what the efficient market hypothesis is, you'll get number 2 right on the test. Number 3 on the test asks about how stocks basically get their pricing. This is also a problem from last week's material. So how basically do companies get priced as far as their stocks? Okay. How do they get priced? How do we come up with the pricing for stocks? And what are some of the challenges with pricing stocks? I mentioned earlier tonight that stock pricing can come from people's emotions, right? How they feel about a company, how popular a company is. Primarily, obviously, people are investing in that company because of how successful the company is in creating revenue and profit, right? That's the most important thing, revenue and profit. But secondarily, there are a lot of other side issues that go into pricing on stock. And it can create a situation where stock pricing isn't as predictable as we'd like it to be. It's not nearly as predictable as bond pricing, right? Like we talked about tonight. Number 4 on the test. We want to know for number 4, and this is also from last week's material, why it is that small company stock usually outperform other types of companies. What does the book say about why small company stock usually outperforms other stock? Okay, why is that? Number 5 on the test asks you to basically understand the difference between efficient market hypothesis forms. There was strong form, semi-strong form, and weak form. Just make sure you understand the difference between those 3, and you'll get number 5 right on the test. Number 6 on the test is asking you to understand the relationship between interest rates and bonds. So we told you the most important thing to come away from tonight, right, is that when interest rates are expected to go up, we expect bond prices to go down. And when interest rates are expected to go down, we expect bond prices to go up. So you know how we call different markets bullish or bearish? Bearish means that we expect them to go down. Bullish means that we expect them to go up. If we expect interest rates to go down, then we're bullish on the bond market. We expect bond pricing to go up, and vice versa. So keep that relationship in mind for number 6. Number 7 on the test talks about interest rates again and how important they are to bonds. Number 8 on the test, you need to understand what debentures are. Debenture bonds. Just look it up. Just make sure and note it when you're reading through it. If you understand the basic definition of a debenture bond, then you'll get number 8 right on the test. Number 9 on the test asks you to understand between different companies which companies would require the highest cash. Okay, so it's kind of a corporate finance question, but it would be in the bond section in chapter 11 when we talk about companies that need high levels of cash versus companies that don't. Okay, so what's the difference between those companies? Number 10, you'll want to know some of the features of bonds, and we didn't really go into the details on the different features, but you want to know the difference between like a call feature. Okay, what is a call feature? What is a put feature on a bond? What is a sinking fund feature? What is a sinking fund feature? What is a call feature? What is a put feature? If you know those 3, you'll get number 10 right on the test. What do those features mean? They're parts of a bond. Some bonds have them, some bonds don't. They affect the price of a bond, and they also give you different rights. And so you need to understand what those rights are based on those 3 different features that I just mentioned, and you'll get number 10 right on the test. Number 11 on the test, make sure you understand what the real rate of interest is. What is the real rate of interest? What does the book say the real rate of interest is? Number 12 on the test talks about municipal bonds. Okay. What is the difference between corporate bonds, municipal bonds, and government bonds, U.S. government bonds? U.S. government bonds usually have, so corporate bonds usually have the highest yields, and then U.S. government bonds have the next highest yields, and then municipal bonds. Why? Why do municipal bonds have such low yields? Because their interest is tax-free. So they can justify paying us less because we don't have to pay taxes on it. Okay, so keep that in mind for the test on number 12. You'll get that one right. Number 13 on the test, we talk about risk associated with bonds. Make sure you understand what that means. Why do bonds have risk, and what is that risk? Make sure you understand the ratings and how the ratings of a bond affect the interest. You'll recall we talked about how if a bond has a higher rating, then they pay a lower yield or lower interest rate. If they have a low rating, like you and I, when it comes to credit cards, we're going to have a higher rate, right? So if we have a low rating, we get a higher rate. If we have a high rating, we get a lower rate. There's an inverse relationship between rates and rating. Excuse me, my mouth is getting dry this evening. I keep having to take drinks. That means I've talked too much. We're almost done. Number 15 on the test. We need to know about the difference between inflation and interest rates. We talked about the correlation between those two. We showed you a chart between interest rates and inflation, and I told you when interest rates go up, or excuse me, when inflation goes up, usually interest rates go up, and when inflation goes down, usually interest rates go down. So just make sure and understand that cause and effect and that relationship before you get to number 15 on the test. If you understand that, you'll get that one right. Number 16 on the test talks about, if you understand the basic advantages and disadvantages of a mutual fund. We talked about the advantages, right? We talked about how advantages of mutual funds are that they're diversified, they have professional management, they usually have lower costs as far as efficiency of investing. But one of the negatives of mutual funds, there are a few different negatives. We just need to understand what those are before you get to the test. So understand what the book says in chapter 12 about some of the cons of mutual fund investing. So what are some of the negatives of mutual fund investing? And you'll get that one right on the test. Number 17 on the test. Make sure you understand what a mutual fund custodian is. What is a mutual fund custodian? If you understand what that is, then you'll get number 17 on the test, and that'll be in chapter 12. So just take a note. What does it mean to be a custodian of mutual fund assets or mutual fund cash or mutual fund positions? What does that mean? Okay. What is an advantage that a mutual fund has as far as taxes are concerned? Just make sure you, before you get to the test, you understand what chapter 12 says about what advantages do an investment company have regarding taxes. Investment companies are companies that are in the business of offering mutual funds. Okay, so when you see the terminology investment company, just know that they're talking about companies that manage and offer mutual funds. What is their advantage when it comes to taxes? Before you get to the test, that'll help you get number 18 right. Make sure you understand what their advantages from a tax standpoint are. Make sure you understand basically what the book says about open-end companies, investment companies, which are basically companies in the business of selling and managing mutual funds. And then for number 20 on the test, make sure you understand what a closed-end mutual fund is. You've got open-end mutual funds and you've got closed-end mutual funds. And what are the main differences between them, kind of the pros and cons of open mutual funds and closed mutual funds. Okay, did everybody get their 20 topics to feel like they know what to expect on the test coming up? Any questions or clarifications on those? Sorry, Christina. I try to go through them fast because I don't want to go through them too slow. You can always go back and listen to them again if it helps. Number 7 on the test is basically needing to understand, Amanda, why interest rates are so important to bonds. And we've talked about it quite a few times, but maybe that's why I kind of glossed over it. But why is it that interest rates are so important? In fact, why are interest rates the most important thing when it comes to bond investing? If you can kind of think through why what the answer is to that question, then you'll get number 7 right on the test. Okay. Other questions? All right, we have a few minutes left. Since we don't need to talk about the test anymore, unless you've got some other questions, just write them in, let me know. Since we don't have any more questions there to review, what I want to do for just a couple minutes is explain this index issue again, because I kind of glossed over it, and indexes are very, very important. Why are indexes important? Because they give us a measurement of an idea of how that particular index or category of the market is doing. So why is it on the news every single day, multiple times a day, they report on what the Dow does and the S&P and the NASDAQ? So here in Utah, if you listen to KSL, which is kind of the main talk radio, news station on the radio, they will multiple times an hour tell you what the stock market is doing. And the way that they tell you what the stock market is doing is they tell you what the Dow is doing, what the S&P is doing, and what the NASDAQ is doing. Almost always, if any of one of those three is significantly up or down, the other two are usually going the same direction. Meaning, if the Dow is down big, and let's go back to rewind, not to this last Friday, but the Friday before, when we had Brexit and the Dow was down 611 points, both the S&P and the NASDAQ were down significantly as well on a percentage basis. They're different sized indexes though, so don't get caught up in how many points necessarily, but pay more attention to what percentage those different indexes are going up or down, because the percentages mean a lot more. NASDAQ will always go down by less points because it's a smaller index than the Dow, for example. The Dow is at currently, almost 18,000 points. There's almost 18,000 points in the Dow. So it moves by much more each day as far as hundreds of points than, say, the NASDAQ or the S&P that isn't even close to that. They don't have 18,000 points on those two indexes. And why do we care? Because the Dow historically, these 30 companies that make up the Dow in this index, the Dow historically, the aggregate of those 30 companies, is usually a fairly good reflection or indication of what the market did that day. So what does that mean? Well, if those 30 companies went up, that usually means that the broader market generally went up that day. It was generally positive across the board. If the Dow goes down, it generally means that the market across the board was down that day. Okay. Now, there are always exceptions, because there are always companies, even on a bad day, that go up, right? And even on a good day, there are companies that go down, just depending on what their information and news is for the day. But as a general rule, that's the reason we report that, on the radio and on TV. What did the Dow do? What did the S&P do? What did the NASDAQ do? The Dow is large industrial companies. The S&P is 500 of the largest companies here in the United States across a whole array or different variety of different types of companies. And the NASDAQ is more heavily focused on technology and financials. So the NASDAQ is pretty heavy into tech companies and banks or financial companies. So sometimes when financials and technology are doing really poorly, sometimes the Dow and the S&P don't do as poorly as the NASDAQ, because the NASDAQ is more focused on those two categories. Okay? All right, so now you know a little bit more. When somebody comes on the radio and says, hey, the Dow is up 100 points today, that doesn't mean that your investments are up 100 points, doesn't mean that your investments even went up that day. It just means that generally the market was up, as a cross-section of the market, and people are interested to know from day to day how the market's doing, and that's a good indicator of what their investments probably did that day. Okay? All right. That's what I wanted to wrap up with. Make sure that you understood a little bit about indexes, because I think that is something that we hear all the time. It's nice to know a little bit more about what we're hearing, what it means. Obviously, all three of those indexes are all stocks, right? We've talked about bonds tonight, but when we talk about the S&P, the NASDAQ, and the Dow Jones, those three indexes are 100% stock. Okay, so if you have a bond stock portfolio in your account, your stock portion of your account by and large, will follow whatever the Dow, S&P, and NASDAQ do on a day-to-day basis, up or down. Maybe it'll go up a little bit more or down a little bit less, but in general, it'll follow the direction of where those are going. Okay? All right, everybody, have a great evening. If you have any questions, stay on, ask, or zip me a quick email. I did post Lindsay Hawes's information. She's the learning coach for the class. I think I didn't look at it, but I would guess that she's probably going to be up for Thursday or Friday during a session, that you can go in and ask any questions that you have or any concerns that you have. And you can also just email her on a one-off basis and set up a time if it makes sense to get some help from her. So have a great evening. Have a great night. Good luck this week. Let me know if there's anything we can do to help you out. And all of you are much, much smarter now that you came and listened to the session. Have a great night. We'll see you.